Hey traders, this is Blake Morrow with Trader Summit, and with me is Jim Welsh. We're back for a brand new 2022, back at it on Fridays.
Yeah,
Good to see you, Jim. Happy New Year. Hope you had a great holiday season.
we did. And Happy New Year to you and all of our listeners. Thank you.
Awesome. Well, I'm excited to have you back because I really, I think we got a lot of things to talk about.
Yeah.
Things that have developed here over the last, especially even the last few trading sessions, this first week back. First of all, we got a move in yields, which I know you want to talk about, but really, we saw the market react pretty aggressively post the FOMC and the FOMC
Yes.
meeting minutes. And it's like, we sat there and I mean, we all know that the Fed is, turning hawkish and they're going to tighten monetary policy, but now it's really starting to really move expectations even further, more hawkishly in favor of the Fed being more hawkish and raising rates. So tell us why the market finally came to this conclusion after the meeting minutes this week.
Well, the real interesting thing, Blake, is Treasury yields on Monday, I think we're up about 11 basis points. The minutes didn't come out until midday on Wednesday. So the Treasury market was already aggressively moving higher in terms of yields. And that has been a position I've had for really a few months, that we were coming to this juncture where the Treasury would begin to issue more debt because they couldn't, because the debt ceiling precluded it. And the Fed was going to be winding down its purchases. So it was the perfect storm. And inflation is going to continue to get worse in the next couple of months. So to me, the real news wasn't what the Fed minutes was, it's what was happening with Treasury yields. And the S&P peaked in on Tuesday morning, first thing, and started to back off well before the minutes came out. So to me, the real driver of this whole thing was Treasury yields, which broke out on Monday. And my weekly technical review on Monday afternoon highlighted that.
Now, Jim, a lot of people say, well, the market's really not going to care until, yields on the 10-year are above 2%. But is that just too much of a generalization? And should we be more concerned with, what the yield curve is doing and what real rates are doing? I mean, what are your thoughts here?
Yeah, it isn't so much if the 10-year goes from 150 to 2% over 6 months, that's the equity market can handle that. But if it goes from 150 to 2% in 6 weeks, the equity market's going to struggle. So it's more the velocity in a short period of time in terms of yields moving, Blake, that I think has a greater impact. Valuations are stretched. No matter which metric we look at, they're stretched. And most models of valuation depend on the 10-year Treasury. So you go from 150 as you continue to ramp higher. Valuations have to get compressed at some level, and we're really seeing that this week in terms of the stocks with the highest PEs, highest valuations are the ones that got hit the hardest this week. Whereas more economically sensitive sectors like financials, industrials, basic materials, they've been holding up quite well. So again, to me, this was all scripted. This was what was coming in the first quarter. The only surprise for me, quite honestly, is I thought it wouldn't happen for another few weeks. That we'd have another push up in January, and then this would start to unfold. But to me, this was a layup in terms of seeing this coming.
Okay, so today you actually brought me a chart of you brought us, excuse me, the Trader Summit community.
You're important, Blake, but
hey, thank you very much. But you brought us a chart of the 10-year yield, and I'm gonna pull that up right now so everybody can see it. So what's this telling you? I mean, we're up against the highs. I see that, but are we going to break out? What's your analysis telling us here?
Yeah, all along my take has been is that we were going to see the 10-year jump above the high from last March at 1765. That's happened today. I don't think today's the high. I think it's going to continue to move up. One measuring stick, you can't quite see it on this chart, but off to the left, the low in August of 2020 was 0.50 on the 10-year. It then jumped to 1765. That's 126 basis points. You add it to the low from last July at 1.128. And it says, okay, if the two legs are equal, you're talking 238. So I just think that implies that we will see the 10-year above 2%. and my guess has been you get up to about 210 or so, at some level, we're going to spike up to and then go into a sideways trading range. But in the near term, I don't see anything stopping the market from continue to push higher. People were really complacent. To answer your first question, Blake, why did the minutes have such a meaning? Part of it was complacency. People were looking, and I heard it on CNBC a lot in the last couple of months, that the 10-year Treasury yield, since it hasn't gone up, even as inflation has gone from 2 to 6%, is telling me inflation is not a problem. Are you kidding me? An increase from 2 to 6% is a problem. Talk to a lot of people that are starting to struggle to, meet costs of living and so forth. It is a problem. So, those folks believe markets discount the future. I believe that's baloney. All right. And the net result is it was a supply and demand issue where the Treasury wasn't issuing bonds, the Fed was buying everything hand over fist, and now all of that's changing. So I think Treasury yields, the 10-year is going to go above 2%.
So you don't think we're like at peak, yield, where we, everybody's like the talk this week has been,
yes,
the Fed, we're at peak Fed hawkishness. Like everybody right now is saying that they're way too hawkish. They're gonna turn more dovish moving forward. But you're not necessarily in that camp then.
No, I think that it's going to get ramped up more because the inflation numbers are going to continue to worsen. And so the market is, I think, at some point in time, and you and I think talked about this probably 4 to 6 weeks ago, we would come to a place in the first quarter where the market would anticipate more aggressiveness from the Fed than is likely. But in the next few weeks, I don't think that's the case. I think where that starts to show up is in the second quarter, because if we get into May and June, inflation numbers are going to start to come down. I think the Fed very well may increase rates at the March meeting and May meeting. So in other words, 2 rate increases before the mid-year. And I think there's a pause at some point in time out there where the Fed says, hey, we've eliminated our bond buying. We've raised rates a couple of times. We're talking about shrinking our balance sheet, and inflation is starting to come down. We're going to hit the pause button for a while to wait to see how this plays out. I think that happens in the second quarter. But in the first quarter, I think concerns are going to continue to ramp higher.
All right. Well, technically speaking, let's talk a little bit about the S&P here.
Yes.
We ramped up to all new time highs. Actually, the Dow was touching all time highs, I believe, Monday this week.
Yes. Yeah.
And then, you look at where we're closing right at this moment. Now we still have some hours left in the trading session, but the way it sits right now, we're going to have a bearish engulfing candle on the weekly S&P. We're going to have a false breakout. What does that tell you as a trader? Like, how do you think we should take advantage of this higher yield environment if the Fed's going to continue to ramp up rhetoric and, they're going to fight inflation at the cost of equities? I mean, how do we trade it? How do you express this?
Well, again, over the last month or so, when we've had our conversations, my take was I think the S&P was going to rally into the first part of this year between 4,800, 4,900.
But you didn't clarify what was going to happen the first day of the year.
I did not clarify that. But the assumption here, Blake, was that everything unfolded as I just described, with yields going up and so forth, and the market over anticipating Fed tightening. A
little quicker than you had thought.
Yeah, 10 to 15%.
Yeah.
So to me, all this is following the script. Now it comes down to near-term squiggles. Looking at the high that we saw earlier this week, a drop below yesterday's low at 46.71. You then see 5 down on the S&P. You could probably drop to 46.30 to 50 in that range. Then we're going to get a rebound. I still think the market is, after we get this initial flush, we're going to see a snapback rally that takes the S&P back to 4750, 4800, and maybe even a little bit better than that. Why? Because the 10-year getting near the March highs, it exceeded it by a small amount. The 30 is still, I think, got up to about 215. The high in November was 217. So we've had a heck of a move up in yields in 5 days. At some point in time, we're going to see Treasury yields come down a little bit, just like all markets. There's profit taking for those who are short. There's people are going to be looking to buy a little bit because the yields are at 176 instead of 150. And that might provide enough relief then on some of the high tech stocks, which are the ones that have gotten hit. So I think we're nearing a point next week where we're likely to see treasury yields ease. The stock market's going to have a rebound. But ultimately, I think we're going below 4,500 and potentially 4,350. We'll just have to see what kind of bounce materializes, how strong it is, and what price levels we reach.
Well, 4,350 from here is probably about another roughly 7-8% lower. But that, we're still not in, we might be in correction territory, but not bear market territory by any stretch of the means. That really keeps the S&P upside in play. But, real quick, as we're wrapping things up, Jim, we talked about yields, we talked about the S&P. Let's talk a little bit about precious metals and the dollar. I mean, how does the dollar play out here? And precious metals are trading heavy along with some of the cryptocurrencies. So if you're like, well, that's an inflation hedge, those aren't really working out. The dollar's still kind of sideways. How do you play those two assets, like precious metals? And then let's talk about the dollar really quick.
I thought the gold would rally up towards 1835. It got to 1831. I thought it should hold 1785. So if it closes below 1785, I think the upside then becomes much more limited. And in terms of the dollar, I've been looking for a pullback for weeks and weeks. It hasn't gone up really during the last 4 or 5 weeks, but it hasn't been back very much either. I thought it would get below 95.51. I think it got to 95.57 this week, and then it has rebounded. So the dollar to me is in a consolidation phase. My take all of the second half of last year, the dollar's on the way to 100. And so that's the bigger picture. Now it's just the little squiggles. Are we going to have a pullback before that move happens? I still think it's likely, but obviously the shift in monetary policy is, very supportive. And that's why I thought the dollar was bottoming last June when it was trading at 89.5, because Fed policy was going to be shifting well before the ECB. And that meant euro weakness. And, so far that's played out. And I think it's going to continue to play out in the first half of next year.
All right, Jim. Well, we appreciate your thoughts on all of these different topics, especially getting you caught up. We missed you. Well, I know I missed you, and I know your normal listeners have missed you the last couple of weeks, but I'm glad you had a great and safe holiday season. And so we'll look forward to speaking with you next week. And thank you so much for joining us. But wait, before we go, if I'm listening to you for the first time, and I just click thumbs up because I like your content on YouTube, and that's why you should be clicking thumbs up, those of you listening in. And I just subscribed to the Traders Summit YouTube channel. How do I follow you specifically?
Well, I'm at Jim Welsh Macro on Twitter, but also go to macrotides.com to find out more information about the various research reports and trading recommendations I make in my weekly and monthly letters. And I'll tell you guys, as a subscriber, a person myself receiving Jim's work, it's a great, not only is it a great, weekly technical reviews and all your macro reports, but you also update people along the way if things are changing. So we appreciate that. And I know people are going to enjoy it. So Jim, thank you so much. Have a great remainder of your week and weekend, and we'll catch you next week. You got it. Thank you very much, Blake. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.